We now continue with section 5, financial statement disclosures and analysis and disclosure. Disclosure of long-lived assets can be used to assess a company's usage of its assets, the average age of assets, the average remaining useful life of assets, and so on. A company must disclose the depreciation method, the gross carrying amount, and the accumulated depreciation at the balance sheet dates for each class of property, plant, and equipment. So if you want to learn something about the long-lived assets being used by a company, you should study the footnotes in detail. This is a relatively straightforward concept, but it's quite testable. In fact, in the curriculum, there are several questions related to what I'm going to talk about here. If you want to come up with the estimated total useful life of the long-lived assets, what do? You can take the time elapsed since purchase, so that is the current age of the assets, plus the estimated remaining life. This will give you the total life from the start of the asset to the end of the asset. The estimated useful life can also be calculated by taking the historical cost, so that is the overall gross cost, divided by annual depreciation. This is an approximation and it makes a simplistic assumption that the salvage value is 0. How can you come up with the historical cost? This is a very straightforward relationship. You just take the accumulated depreciation and the net PPE. The accumulated depreciation will give you a sense for what has depreciated so far, plus net PPE. This gives you historical cost. What about the estimated remaining useful life of the assets? Why is this important? You might figure out that the total life is 12 years and you want to see how long these assets have been used for. If you figure out that this number is 10, then that tells you that pretty soon there'll be some major capital expenditures. So you come up with this number by taking the net PPE and divide by the depreciation expense. And the average age is the accumulated depreciation divided by depreciation expense. So straightforward relationships, make sure you know them well. All right, now we come to section 6, which is leasing. And this is more or less similar to what you've seen at level 1. I'll go over the main points and then you need to do the examples, which should look familiar. The recordings for the examples are available separately in case you need help. So a lease is a contract between a lessor and a lessee. The lessor is the owner of the asset and the lessee is the user of the asset. So the lessor owns the asset but gives the asset or leases the asset to the lessee. The lessee uses the asset and then makes payments to the lessor. The lessor grants the right of use of the assets to the lessee. The right to use could be a long period such as 20 years or even a short period such as a month. So this would be a simple rental. In exchange for the right to use the asset, the user makes periodic payments to the owner. All right. Now, why would an entity lease rather than buy? Because if you think about it, if you need an asset, you can borrow the money, finance your purchase, and use the borrowed money to buy the asset, or you could lease. What are the advantages of leasing? One basic advantage is that it is generally less costly, because when you lease, you are making payments and in a sense the machine that you are leasing is automatically the collateral. Plus very often the entity that is leasing the machine to you has an interest that you use the machine, so they might offer favorable financing terms. Another is less restrictive provisions. When you borrow money, let's say you issue a bond, there will be this indenture where there will be all sorts of covenants, all sorts of requirements that you need to meet. But with leasing, while there are still requirements that you need to meet, but they tend to be less restrictive relative to borrowing. reduced risk of obsolescence. If you borrow and buy and the machine is obsolete, then it is your problem. On the other hand, if you have leased the machine, then at the end of the lease, you return the machine and don't really worry about it. This is a useful method for off-balance sheet financing. If you lease a machine and it's classified as an operating lease, which we are going to talk about shortly, then that particular asset and the lease payments do not show up on your balance sheet. Since they are not on your balance sheet, various ratios such as profit over assets, so return on assets and so on, tend to look much better. Your activity ratios, sales divided by assets, also look better because your asset numbers are lower. Your liabilities are also lower because the lease liability does not show up on your balance sheet if it's a operating lease. And then this is a subtle point. You don't need to go into the details here. Just recognize that in some countries, such as the United States, there is a tax advantage. So specifically in the US, firms can create a synthetic lease but treat the lease as ownership for tax purposes. When treated as ownership, then you can show depreciation, which allows you to reduce taxes. I alluded to this kind of lease, which is an operating lease. Broadly speaking, there are two categories of leases: operating leases and finance leases. An operating lease is an agreement allowing the lessee to use the asset for a period of time. This is essentially a rental. One entity is using the machine and then making monthly or quarterly payments. On the other hand, a finance lease is effectively equivalent to the purchase of some asset by the buyer, who's the lessee, that is directly financed by the seller or the lessor. Now, in the two major accounting standards, IFRS and US GAAP, how do we figure out whether a lease should be classified as operating or finance? IFRS makes a high-level principled statement which says that if the transfer of asset is such that the risk and rewards are also transferred to the lessee, then the lease should be classified as a finance lease. If not, then it can be classified as an operating lease. US GAAP makes some more specific remarks which are stated in the footnotes in your curriculum, but I have given them here because I think they give you a better indication of how to classify a lease. If the ownership of the leased asset transfers to the lessee at the end of the lease, then it should be classified as a finance lease. Or if the lease contains an option for the lessee to purchase the leased asset cheaply, or a bargain purchase option, then again finance lease. If the lease term is 75% or more of the useful life, then finance lease. If the present value of the payments is 90% or more of the fair value, then again classify as finance lease. Notice that all these conditions are OR conditions. If any of them holds true, then you classify as a finance lease. And also note that if any of these hold true, then effectively the risk and reward is being transferred to the lessee. So at a high level, both IFRS and US GAAP are saying the same thing. Now, how do you report and account for a lease? The reporting varies depending on whether you have an operating lease or a finance lease. With an operating lease, you do not record any asset, you do not record any liability, so no entry at the inception of a lease. But for every period, you show a rent expense, which is an operating expense, equal to the lease payments. And this expense is shown in the income statement for every period. These would be period expenses. Note that we do not have the creation of any assets and any liabilities, so there is no impact on equity. What about a finance lease? If a lease is classified as a finance lease, then here is what needs to happen. At inception, the present value of future lease payments is recognized as an asset and as a liability on the balance sheet. When you work through examples 10 and 11, you will see this happening. But if you lease a machine, you are going to make certain payments. you figure out the present value of those payments. Let's say the present value of those payments, the lease payments, equals 100. Then you show an asset on your balance sheet equal to 100, and you also show a liability on your balance sheet equal to 100. What is the impact on equity? Impact on equity is that there is no impact. What is this liability called? This is the lease payable. What is the asset? The asset is the machine that you have leased. Then over the life of the machine or the life of the lease, what do you do with the asset? You depreciate. If you have this machine for 5 years, then you depreciate for 5 years. What about the liability? As you make lease payments, the liability also comes down. For every period now, there are two kinds of expenses. There is the depreciation expense, and then there is the interest expense associated with the liability. There will be a certain interest rate associated with the lease, and your interest expense for every period will be equal to the lease payable, the outstanding liability at the start of the period, multiplied by the appropriate rate. Again, this material is covered in examples 10 and 11, which are similar to what you've seen at level 1. I want you to do these examples, and then you can look at the solution in the curriculum, or you can look at the videos which will be made available to you. From an exam perspective, this table is extremely important. You need to understand the impact on various financial statement elements of whether leases have been classified as finance leases or operating leases. So before I show you the solution over here, what I want you to do is fill out this table. And just to make sure you understand what's being asked, let's say that a given company has a choice. It can either classify its leases as finance leases or operating leases. There is some subjectivity involved. So with finance leases, will the asset value be higher or lower relative to operating leases? Will liabilities be higher or lower, and so on? So fill this out. Let me make a note. So notice that we talk about net income here over 3 different rows. Net income in the early years. You can think of this maybe in the first year where the leasing happens. With a finance lease, there are 2 kinds of expenses. There is the depreciation expense, and then there is also the interest expense. The interest expense is relatively high in the early years, and you'll see this in examples 10 and 11. Since the interest expense is high, the overall expense, interest plus depreciation, is high. Overall expense is high means that the net income is lower. With operating leases, it's the same standard expense throughout. Later years means that now the interest expense becomes low because the outstanding lease payable is low. Since that number is low, interest expense is low. Depreciation is still the same, but the combined effect is low relative to the expense, overall expense associated with an operating lease. Therefore, the net income is higher in later years for a finance lease. When we say total net income, this means over the life of the lease. So these two balance out, the lower, higher balance out, and if you have a 5-year lease, then over the 5 years, the impact on net income will be the same. Obviously, this is ignoring time value of money. This is purely from a undiscounted cash flow perspective. The rest is fairly straightforward. So I'll just explain the CFO also. Remember that with a finance lease, we have 2 categories or 2 types of expenses, the depreciation expense and the interest expense. Whereas with the operating lease, we just have that operating lease expense. That entire operating lease expense is going to lower your CFO, whereas in the finance lease context, only the depreciation amount is lowering the CFO. So the CFO will be higher for the finance lease. And for the same reason, given that interest expense is showing up in the financing section or the CFO section of the cash flow statement, the cash flow from financing will be lower for the finance lease. Given what we've just talked about, you should also be able to understand the ratio impact of lease accounting. Again, I want you to fill this out before you look at the solution. And here is what you should come up with. The idea again is straightforward. You need to write down the ratios and then think about the elements from the previous slide and convince yourself that this is indeed true. So this current ratio is a little bit tricky. If you think about an operating lease, there is no impact on the current assets or the current liabilities. If you think about an operating lease, there is no impact on current assets, but current liabilities will be higher because there will be a lease payable and there will be a current portion of the lease payable, which will make the current liabilities higher. Since the current liabilities are higher, the overall ratio will be lower. So the other slightly tricky one is debt over assets. In absolute terms, both debt and assets are going up by the same amount. But for most companies, and especially companies that you would be interested in, the asset value should be higher than the debt value. So if you have a company with assets equal to 2,000 and debt equal to 1,000, and then based on the finance lease, let's say 100 is added to both the debt and the asset number. The percentage increase in debt is going to be more than the percentage increase in assets. Therefore, the overall ratio for the finance lease will be higher. When a company has a substantial amount of operating leases, adjusting reported financials to include the impact of capitalizing these leases better reflects the company's solvency position. The critical point here is that you as an analyst are looking at the financial statements of a company and you notice in the footnotes that there are several operating leases. Now, when there are several operating leases, obviously this means that the company needs to make lease payments. So there are obligations. So to get a better sense for the leverage ratios, debt to equity ratios, what you need to do is convert the operating leases into finance leases. And this is also important if you are comparing companies. One company might be engaging in more operating leases, the other might be taking on more finance leases. The accounting treatment is obviously different, so you need to bring both to the same standard or the same assumption before you compare. Now you need to do example 13, and a recording for this example is also available. So far we've taken the lessee perspective. Now we look at the reporting by the lessor. In an operating lease, the lessor will record the revenue when earned. So what is the lessor getting? He's getting the lease payments that represents his revenue. So report the leased asset on the balance sheet. In other words, since we are categorizing this as an operating lease, the asset is not transferred. The asset remains on the balance sheet of the lessor, and then that means that the depreciation expense also is there for the lessor. What about a finance lease? Here the lessor is effectively selling the asset. So the lease receivable is the amount that is shown as an asset. The asset itself is removed from the balance sheet because the asset then moves to the lessee. Under US GAAP now, there are two categorizations, a direct finance lease and a sales type lease that we will talk about on the next slide. A general remark first though, when a lessor reports a lease as a finance lease rather than an operating lease, it usually appears more profitable in the early years of the lease. This is the opposite of what you saw for a lessee. If you recall the ratios we saw were from the perspective of the lessee, and in general the ratios were better for operating leases. With the lessor it's the other way around, because if the lease is a finance lease, then the assets move away from the balance sheet, so activity ratios, return on asset ratios, etc. would look better if the asset is removed. Now let's look at the two types of finance leases. This is from a lessor perspective, and this is only under US GAAP that we have these two categorizations. We can have a direct finance lease or a sales type lease. In a direct finance lease, the present value of the lease payments is equal to the carrying value of the leased asset. So if the leased asset on the books of the lessor is 100, so this is the carrying value of the asset, and then this asset is quote unquote sold because this is the finance lease, and the present value of the lease payments also equals 100, then there is no gain on sale. So what is the lessor doing here? He is essentially facilitating a financing transaction. So that's why this is then called a direct finance lease. What is the revenue gained in this context? The lessor simply earns interest revenue. Where is this interest revenue coming from? If you think about it, over a certain period of time, the undiscounted cash flow or the amount of money received obviously is going to be more than the carrying value. The additional money received above the carrying value is the interest. The other scenario is where the present value of the lease payments exceed the carrying value. If the present value is 120 and the carrying value is 100, then that extra 20 is booked as a profit. Just like when you sell something, if you sell something for greater than the cost of goods sold, that is profit. So in this scenario, it's called a sales type lease because you have sold, so there is a gain on sale, plus there is the interest revenue that the lessor will earn. Now you can do examples 13 and 14. We will now summarize this reading. As I mentioned before, this is largely a repeat of level 1, so it is fairly straightforward. You need to understand the impact of expensing versus capitalization, and specifically the impact on financial statement elements and ratios, the impact of depreciation, especially straight line depreciation versus accelerated depreciation, the impact on the asset numbers and then various ratios, as well as income statement impact. Then the impact of impairment and revaluation on financial statements and ratios. You need to know the financial statement disclosures regarding long-lived assets and how you as an analyst can take advantage of these disclosures. You can come up with the estimated remaining life, you can come up with the total life, and so on. Then you need to understand the impact of lease versus purchase decisions, and finally the impact of categorizing a lease as a finance lease versus an operating lease, both from the lessor perspective and the lessee perspective. As always, I want you to read the summary, review the learning objectives. I have covered the examples, some of them, but you need to go over the examples also, and then if you have issues, look at the curriculum or look at the example videos. Do all the practice problems, this is critical, and if you have time, then do practice questions from other sources as well.